Thank you, Larry. I apologize a bit. I'm just getting over a cold, so if this were an opera, I would have to have a stand. But I don't sing. Although one of our speakers today is a singer. Well, I don't know about you, but for me, the last 2 or 3 years watching the financial markets have been like being on the world's biggest, fastest, tallest roller coaster and riding it blindfolded. I'm not sure whether our speakers today are going to get us off of this roller coaster, but hopefully they will move the blindfold up a little bit so maybe we can see where we're going. Before I talk about our primary speaker, Ronald Florance, I want to just make a remark or two about Wells Fargo. Depending on how you measure, Wells Fargo is certainly one of the top 5 commercial banks in the United States today, whether that's by assets, by deposits, by market capitalization. More importantly, it is one of the safest banks in America, one of the highest quality debt ratings of any financial institution in North America, actually. And if you think about it over the last 2 or 3 years, if someone were to ask you to put together a list of memorable financial institutions, there's a lot of names that would come to mind. And actually, Wells Fargo may not be one of those names. And in this case, that's a good thing. But I think all the infamous lists I've seen in the past roughly 2.5 years now, their name is usually not there, and that's a very good thing. Not only is Wells Fargo a very successful commercial enterprise, they have a deep and passionate commitment to philanthropy, to the community, to the arts. And those of us in the opera community are large beneficiaries of that. They are contributors to Opera America, to a number of opera companies, including the LA Opera, our home city. They also serve as the investment advisors to Opera America, helping the Opera America team manage the funds that they have responsibility for. So now on to a bit of the background of our primary speaker tonight, Ronald Florance. Ron is the Senior Vice President and Director of Investment Strategy and Asset Allocation at Wells Fargo Private Bank. His responsibilities include providing comprehensive strategic asset allocation, financial planning, and investment management solutions for affluent individuals and families. He has more than 20 years of experience in the financial services industry, including 15 years in the investment management aspect of that industry. Earlier in his career, he worked for Wells Fargo Eco Investment Advisors as the lead portfolio manager in the Strategic Wealth Group. He later managed quantitative equity strategies at First Interstate Bank and the Vanguard Group. Ron has experience in managing private client assets and mutual fund portfolios, as well as developing strategic and tactical asset allocation policies. He has a BS from Brown University in Applied Mathematics and Economics, and in 1995 was awarded the CFA, the Chartered Financial Analyst designation, something that I was awarded many years before that. I know I don't look as old as I am. Currently, Ron chairs the Wealth Management Asset Allocation Committee. He is a voting member of the Due Diligence Committee and works closely with the Chief Investment Officer on the Investment Policy Committee of Wells Fargo Private Bank. As an economist myself, I'm a real junkie for news and information and insight on how the economy is doing. And so I'm very much looking forward to having my blindfold lifted a little bit before the recession's out. Finally, before I turn it over to Ron, actually, I will introduce much more briefly Tim Throckmorton, who is going to give us set the stage a little bit for the presentation that Ron's going to give. Tim has been newly appointed as the National Director of Philanthropic Services at Wells Fargo Private Bank. And what he may or may not tell you is he's also an accomplished tenor. I really accomplished tenor. So Tim, to you first, and then to Ron.
I promise not to sing today, though, for this illustrious audience. But I did want to tell you that I did have the opportunity to share the stage with Placido at one point in my career. 30 years ago, Opera Colorado was doing their inaugural season. Nathaniel Merrill, who was at that point directing it, Placido did a Rodolfo in La Boheme, and I had the opportunity to sing in the chorus just out in college at that point, and he was so gracious and so wonderful with a young singer at that point, and to see what he's done here with LA Opera is truly amazing. So even though he's not here today, I'm looking forward to meeting him backstage tonight. So thank you for inviting us to be here today. Ron is the featured speaker. I wanted to take a moment to set this up, especially with the passion that I have for opera. It's just a thrill to be here in front of this illustrious audience. I do manage the national team of Philanthropic, and really what my national team does is we work with charities, and we work with wealthy philanthropists, and we try to connect the difference that they want to make in the world to their finances. And that's really an exciting thing to do. So I love my job. And what we're gonna do today is, well, first of all, I want to let you know how integral Wells Fargo is in the philanthropic community as it pertains to arts. And I know many of you are beneficiaries of that, and we just love being partners with performing arts organizations, and we'll continue to expand that partnership. Today, what we want to focus on is really your donor and what your donor's thinking at this point about the changing markets, what donor motivations are as well. And Ron is, as you heard the introduction from, is one of our experts that we bring out to talk about asset allocation, to talk about investments, because he so understands that wealthy individual that you work for, that you work with to give more funds to your organization to keep it going. So that's what we're going to focus on today. And the one thing that you don't know about Ron is that Ron is a fourth generation Angelino, which that is quite something. Even though he lives on that other coast at this point, he's a fourth generation Angelino, and his father was actually in the film business here in Los Angeles. So Ron, for many reasons, can relate to this audience, and let's just give Ron a quick round of applause.
Good morning. Thank you for the invitation. Congratulations, Mark, on your previous 20 years of service, and congratulations on your 20-year contract. I mean, that's how I heard it. Very exciting news here out in America. Very exciting. So one of the benefits of being a long-time Los Angeles resident is, did anybody try to get from the LA airport to Beverly Hills yesterday? So nightmare, right? 405 is closed. Everybody goes down to the streets of West Los Angeles. It is the worst of the worst possible scenario. The first one that came to my head was, oh, it's nice to be back home. And I was on the streets of Culver City needing to get to Beverly Hills, and I knew that there was this back way. You kind of go in the backside of Sony towards Fox, you can kind of get there. So I called my mother. I said, Mom, where's that alley? And she thought, hey, I do it. You know, I went right through somebody's backyard, and I made it in 10 minutes. Very, very good. So, the roller coaster ride, as people refer to, it's still going, by the way. It's not, it hasn't stopped. A little bit of news today, and then we'll get into the topic up on the screen. So the news today: accelerating growth in Australia, Canada, and Japan. Chinese exports grew 48% year over year, is the number that came out today. Increasing global demand. Initial jobless claims in the United States. It's just so abysmal. 456,000 people filed for first-time unemployment claims last week. It's just awful. But all that being digested, the Dow Jones Industrial Average is up nearly 200 points on the day. Interest rates are climbing. The euro continues to decline. The European fall vacation is getting very cheap, by the way. Don't book it yet. It's going to get cheaper. So the roller coaster ride on Wall Street continues. I spend about a third of my time with stock balance sheets, and through the latest conundrum that we've gone through, we've really seen obviously a significant decline in portfolio values. Contributions have dropped off. I don't need to explain that to you. The asset allocations of the endowments and the foundation portfolios are completely out of whack because of the way the markets have moved. And one of the most concerning entities is the amount of distributions coming out of these portfolios. A sustainable distribution of 4 or 5% that was calculated off of 2007 valuations when you're selling 2010 assets to make it was between 7 and 8%, which is not sustainable. So the distributions coming out of these portfolios. So lots of work being done on these balance sheets, and we'll talk about that throughout the presentation. What I want to talk today about is really focus on what are your donors here and feeling and thinking about the economy and the capital markets, and then we'll talk about some specific conversations that you can have with your donors. It's a very, very difficult time. It's been an extremely emotional time for these people, and philanthropic distributions and philanthropic part of their balance sheets have gone to the second tier of concerns, and we'll talk a lot about that. So, with the economy, there are unbelievable numbers of economic statistics. And any talking heads in media can pick one number and extrapolate that out to the future and just make it either Armageddon or euphoria. It doesn't matter, right? So we took a step back and said, let's look at we looked at 200 economic statistics. Are they getting better? Are they getting worse? Are they staying the same? And March of 2009, arguably kind of the bottom of the bottom, it was about a third. Today it is dramatically different. It looks dramatically different. We are very much on the road to, I love Mark thinks about recovery versus discovery. We will talk about economic recovery, but we will talk about discovery with donors. I love that analogy. But I think these statistics are important to keep in mind that we are definitely moving in the path of economic rebound, and that's an important theme to continue to discuss with our donors. Some specific forecasts that we always have to do, they're always wrong, but we always have to produce them anyway. Showing dramatic economic growth, both domestically, but more importantly globally. The global number is much greater than the domestic number. Inflation, we have been lulled into a low inflation environment. Inflation is coming back. We will talk about some specifics of that later, but inflation will come back, and that is very much important in the philanthropic world. Interest rates are going to go up. They've been very low. Dollars going to go to strength. So I guess if I had it right, it would be ho-yo to ho, we're going to recover, I guess, right? I don't really know what that means, to be honest with you. My professional mentor is a woman named Barbara Bruiser, and she works in Beverly Hills, and I told her I was giving this presentation, and she's an opera fan. And she was just started salivating, and she drew up this whole costume of what I should walk with horns and face. Oh my God, I look like Michael Dukakis in that tank. So that's better if I stop referencing that. But nonetheless, we're seeing very much dramatic improvement in the statistics, and I think that's an important theme. Leading economic indicators and GDP, what it comes down to is we've had basically 1 year of leading economic indicators improving. We actually dropped below the improving line in April because of one statistic, but that's a pretty strong run of a year. We also have about 5 months now in a row of leading economic indicators, coincident indicators, and lagging indicators all improving. So that shows great strength and depth and robustness of recovery. We're starting to see GDP growth, positive numbers there. That actually means the economy is growing. So we're moving in the right direction. It looks like if we had the choice between economic Armageddon and economic recovery, we are falling into the camp of economic recovery. Bumpy, absolutely. Extremely robust, as you would expect out of a very painful recession, and we have a lot of headwinds to worry about. When we talk about the donors are consumers, they're people. So what are people doing now? They're starting to spend money again. Literally the week after Lehman Brothers failed, they stopped spending money. It was the most astonishing economic experience ever. They just stopped spending money. Money didn't move through the economy at all. That has come back. So we're seeing retail sales. If you take the auto sales is taken out, that's what the bar is. Auto sales is very volatile. That's why there's 2 bars on there. What's happened is, though they stopped spending money, their stuff didn't stop depreciating. So tires were going flat, dishwashers were breaking, jeans were getting older. That stuff is being replaced. So we're seeing that level out of activity. And literally, it's just replacement of depreciating assets. We haven't really seen an increase in demand because of conservative balance sheets, but we think that's good. But nonetheless, donors are starting to spend money again. So once they replace the depreciating stuff, then it goes to the next tier of financial concerns that they have, and that's typically some philanthropic entities. Debt service, so we're in the process of deleveraging, right? You hear this term all the time. People had too much debt. And there's actually 3 phases of deleveraging going on. The first phase happened at the beginning part of the decade, where corporations in the 80s and the 90s just racked up a lot of debt. They were spending like drunken sailors, and the dot-com bust kind of fixed that, and they repaired their balance sheets. Now we're in the process of individuals are repairing those balance sheets. You can see from this chart that debt levels are back to kind of where they were at the beginning of the decade. So great improvement. Incredible frustration for short-term economists. Very frustrating to bankers because people aren't borrowing money anymore. And that's actually a good thing. They were borrowing too much money. But balance sheets are they look much better. So when balance sheets improve, confidence improves, and we can see a follow-through on that. This is an incredibly important aspect. The third phase of the deleveraging is sound balance sheets. So governments continue. You cannot borrow your way into financial prosperity. And Europe has started the process along the way. And the reality is Greece is, who cares? Greece has the GDP of Rhode Island. Sorry, I went to school in Rhode Island, so I can say things like that. But the reality is lots of sovereign balance sheets look kind of similar to that. So we all have to start paying attention to better austerity measures. The big concern in terms of the feeling, does this feel like we're actually going into a better economic time, is unemployment. And unemployment is just awful. Numbers again came out. There is no way that you can have 456,000 people applying for first-time unemployment claims and have an improvement in the economy, in the improvement in the unemployment numbers. So that's why instead of having 4% growth, we're thinking 2 to 2.5% growth is more realistic. And the reality is, the charts there, by the bars are we adding or deleting jobs from the economy? We're now starting to add jobs to the economy, so we're moving in the right direction. And then the green line is the unemployment rate. The unemployment rate is going to stay elevated for a really long time. A really long time. It's probably going to even increase throughout this year. Because what's going to happen is we start adding jobs back into the economy, which we're starting to do. People that have been sitting on the sidelines say, well, if I can get more than $3 an hour, maybe I'll go look for a job. And so the unemployment rate is 2 numbers: how many people aren't working and how many people are trying to look for a job. So there's 2 aspects of that, and they're changing. So we think, as more enthusiasm comes from the job market, the number of people looking for jobs will increase, the unemployment rate will increase. The problem with that is political. That number is going to stay very elevated all the way through the midterm elections. So politicians are going to go back into their districts and say, you know what, I know next year your taxes are going up, and I know the value of your house is really low, and I know you can't really get a very good job, but if you vote for me, it'll just get better. So that's not a very good platform to run on, so we're going to see a lot of movement that. When will we see unemployment get back to a more sustainable level? Long-term sustainable unemployment in this system is 5 to 5.5%. During the real estate boom, we got down to 4.5%. That's not sustainable. That's inflationary. When are we going to get there? 7 years? It's an incredibly long time. Because this is not about shutting down factories, letting the inventory run down, and then bringing it back up. You have to retrain the labor force. If you go from picking corn to picking soybeans, you figure that out in about 10 minutes, right? It's not a very long program. But if you go from building cars to working in an intensive care unit, it takes years of training. And the reality is we have too many people building cars and building houses, and not enough people in education and in healthcare. Those jobs take training, so it's going to take a long time. That's why we think kind of growth, but muted growth below the 3% level until we get this under control. This is about global. The United States is not leading this economic recovery. The United States is following this economic recovery. The emerging markets are leading it. Then developed Asia and developed America is next, and then Europe is falling a little bit behind, but still growing. If there's any region that has an opportunity for double dip, it is Europe, until they can figure out just how they can digest all the austerity measures. But I think this is a very important theme when you talk about the management of money and balance sheets, that it is a global economy that we are working on now. We have the global capital markets that we're investing in, and it's a global recovery that we want to participate in. Some of the market outlooks, again, forecasts, wrong, but nonetheless presented. showing positive movement. We think the stock market will continue, though very, very volatile. If you can see in the bottom line there, we'll talk about that in a minute. But the reality is improvement. Not great improvement. We don't expect PE ratios, which is a valuation measure, to increase dramatically, but earnings will increase and then prices will increase with them. Up until now, kind of that high-risk stuff, small cap stocks, emerging market stocks, high-yield bonds, the kind of high-risk stuff, has done very, very well. We think in a more maturing part of the recovery phase, going back to quality is going to really come to fruition. We want to emphasize that in all of the client portfolios. The bottom line there, the VIX Volatility Index, staying very elevated. I think 23 is actually a little bit low. I put it in the more high 20s by the end of the year. Right now, I think we're still in the low 30s. Historic numbers are 15, 16, 17, something like that. 3 times in history, it went above 40. Started the Iraq War, 9/11, Russian debt crisis, those kind of big catastrophic events. This last economic cycle, it went above 80. Unbelievable. And if you experience anything the last 2 weeks, I mean, every single day, peak to trough on the Dow is 200 points. The amount of money sloshing back and forth, trying to figure out, where we're going. So that volatility is going to stay there. What we don't want to do is sit on the sidelines waiting for volatility to go away and then start taking action, because we're going to miss enormous economic opportunities. We have to manage volatility, we have to use it to our advantage, and that is a huge, huge aspect for philanthropic giving, and we'll talk about that in a minute. So once we go through all this kind of economic capital market, there's these investment themes we talk about, and then we'll get to some specific conversations. I think it's important that you understand what investors who are your donors are thinking about what they're doing with their own portfolios and their own balance sheets. These are 5 themes that we're talking about with our clients today of what we think they should do to reposition their balance sheets to discover the new economic opportunities available to them. First of all, global recovery. And by the way, this goes to your own balance sheets, and it also goes to the foundations and endowments that you're responsible for from a fiduciary standpoint. Global recovery, as I said before, the United States is not leading this one. The emerging markets are actually leading this one. There are 3 pools when you look at the world. The developed world, that's Europe, developed America, developed Asia. Emerging markets, you commonly hear the acronym BRIC, Brazil, Russia, India, China. It's become such a popular part of lexicon that it was last week a Final Jeopardy answer. I was stunned. Only one person got it. I was really kind of embarrassed by that. But when we think of emerging markets, we need to think well beyond Brazil, Russia, India, China. The huge population, but there's enormous emerging opportunities in developing Asia and South America and in developing Europe. And then the third group is, we call them frontier markets. So that's primarily Africa and the Middle East. Those are more philanthropic investing. They have political issues, infrastructure issues, social issues. A nice thing to do, but let's be realistic about the opportunity. When we look at the world, the opportunities are just vast. To put it in perspective, if you have a stable roof over your head and a 3-day supply of food and access to drinkable water under that roof, you live in the top 5% of the human population. 5%. By the way, most people don't have the water. It's the water that they don't have. So when you look at the opportunity set around the world, maybe bringing water, a pipeline that brings water into the huts that they're living in would be enormous. So there's incredible opportunity. The global aspects of investing is not just in equities, it's in fixed income, it's in equities, it's in real assets with commodities, which have a very high correlation to emerging markets, and real estate, as well as hedge funds and private equity that invest around the world. So the global theme is very important. So if the global world is going to recover, how are they going to recover? And we talk here about technology and infrastructure. A little bit about infrastructure. So all this global stimulus, right, being pumped through the system, our global stimulus, I think people call it, the magic ring of fire, keeping Valhalla from falling apart, that kind of stuff. Barbara told me that one too. I'm footnoting it all. But the reality is, in this country, only 40% of that money's been spent. 60% is still to come through the pipeline. So I love it when they talk about maybe getting the second stimulus, like, why don't you spend the first one before you start pumping another one of, by the way, money that we don't have to spend anymore. into the system. So that money typically hits infrastructure. It's the fastest way to do it. So either building non-existent infrastructure in emerging markets or crumbling infrastructure in developed markets. Enormous opportunities for infrastructure. Technology are just, it's unbelievable. We tend to think of ourselves in a very technologically saturated environment, right? You know, your car has more computing power than the first space shuttle, you know, that kind of stuff. Most human beings will never make a landline telephone conversation. They will only use cellular communication. Most human beings have never accessed information off the internet. They have yet to get to that technology. The opportunities are vast. I just came back from a trip through Hong Kong, Macau, and Tokyo. In Macau, everybody has a handheld communication device. Everybody had one. And there's a lot of them, by the way, over there. So it's just unbelievable. Even in the developed world, remember Y2K, the world was going to fall apart, planes were going to fall out of the sky and all this stuff. So everybody had to buy new computers. All those computers are 10, 11, and 12 years old. They need to be replaced. So even in the developed world, it's huge. One thing I like to talk about in technology is storage. You have to store all this stuff, right? I have yet to have anybody explain to me how you get anything off the internet. I know how to put it on. There's an ESPN reporter who would love to know how to get things off, by the way. But it's very difficult. Twitter, twits, it's not, twits is derogatory. What is, a tweet, I got it. Whatever. Barbara Bruiser told me to say that one too. Do you know what's happening to all of those? They're being permanently stored in the Library of Congress. So you tell the teenagers in your life before they hit send to remember that that's going to the Library of Congress forever. That's a lot of storage. So the technology, so infrastructure and technology are enormous opportunities that we have in this economic recovery. Volatility is here to stay. There's nothing I can say about it. It's here to stay. You got to manage around it. You got to rebalance. You got to be appropriately diversified. You have to be able to have the discipline to be able to ride through it and not be a short-term trader because you're going to get burned. The reality is the importance of rebalancing makes volatility actually very favorable to a portfolio. Everybody knows the statistic that if you bought an index fund in the last decade, you bought an S&P index fund in 1999 and you sold it in 2009, you lost 10%, right? It's some number like that. But a typical uninteresting 60-40, 60% equity, 40% bond portfolio through the same decade, rebalanced through the decade of volatility, made about 55%. Not a great decade, but a lot better than -10. If you don't rebalance your portfolio, you generally become overweighted in risk. And today, if your donors were appropriately allocated in 2009 and have done nothing today, they're overweighted in risk. Their high-yield bonds are overweight, their small-cap stocks, emerging markets, all that stuff is overweight, so they have to sell it and reallocate their portfolio. Well, instead of just selling it and buying something else, you could also use that as a philanthropic distribution. As part of their rebalancing strategy, you don't need to just put it into cash. You can actually move those assets that create a tax liability into a philanthropic entity, and they'll take care of it for you. So when you talk to the donors, rebalancing is extremely important in volatile environments, and using rebalancing as a philanthropic distribution mechanism is a very, very powerful tool, especially in an environment that we're going into of rising taxes. Tax rates are going up, and if they can use volatility to improve their returns and reduce their tax liabilities through rebalancing, that is an extremely powerful mechanism. Interest rates and inflation are going up. The Federal Reserve balance sheet has increased 2.5 times through this economic conundrum. 2.5 times. That is a massive amount of money being pumped into the system. Inflation is going to come back. We are not in the camp of hyperinflation. We think 3% long term. We think it'll go to 4.5%, probably late 2012, and then come back to a trend line of 3%. So people say, well, that doesn't sound so bad. And it's not catastrophic. The problem is 3% inflation, you lose half your money in 25 years. 25 years. And the money that you're responsible for managing philanthropically and your donors have on their private balance sheets aren't being consumed over the next 2 years. They're going to be consumed over decades or probably generations. That inflation is incredibly corrosive. We need to, today, immunize portfolios. And if you're sitting in a savings account earning, whatever Wells Fargo is not paying you on your savings account, you're not immunized against inflation. You have to do something better. And interest rates are going to be coming up. This is the one that is my biggest concern, is that we have gone through a sustained declining interest rate environment. So when interest rates go down, they went from 20% to 0 is what they are today. When interest rates go down, the price of bonds go up. Well, interest rates are at 0. They're going to go up. And when interest rates go up, the price of bonds go down. So if people are lazy or undisciplined in their bond portfolio, it can be extremely painful in a rising interest rate environment. We need to get people ready for that. Interest rates are going to be going up. We think the Federal Reserve will raise interest rates by the end of the year 50 basis points, and through the end of the cycle 300 basis points. So that'll take kind of money market rate up to the 3 to 3.5% range, 10-year treasuries at 6.5%, mortgages at 8%. So that sounds high by today's standards. By historic standards, it's not. It's very, very normal. So we need to get ready for it. That's a pretty dramatic increase, and that'll probably only take 2.5 years to move that. Once they start moving, they'll just do 25 basis points every quarter until they actually accomplish that. The last thing I want to talk about, and then we'll get to the donors, is dollar diversification. If we're going to have this global exposure, we're going to need to understand the currency risk. Most of the liabilities that you pay for are either in US dollars or Canadian dollars, wherever you're domiciled, but your assets will have exposure to lots of currency volatility. And lately, that should really have been highlighted through the euro and the yen and all this volatility. So really understanding and using it to your advantage. We think currency diversification actually can reduce portfolio volatility, but you have to be aware of how to convert that back to your consumption currency. You really can't pay bills with Hong Kong dollars. You have to convert that back to what US dollars or Canadian dollars or whatever your domicile is. So that is an extremely important part of the diversification aspect. But also for your donors, if they have non-dollar denominated assets, they don't need to convert them back into US dollars to give them to you. You can take in non-dollar denominated and you can do the conversion. So again, for a rebalancing, repatriating, you can help them with that process. They don't have to do it before they give it to you. You can be part of that process. So some of the highlights that I've talked about in ad nauseum, and that's kind of boring. So let's talk about donors. So who are these people that are making all this philanthropic distributions? They're people. That's the reality of it. We all tend to focus on the big thing, the Wells Fargo Foundation and those sort of things that make the grants. 75% of the donations come from people. 80% of households make philanthropic distributions. So though it's nice to go after those big fish and kind of be at those cocktail parties and balls with the big distributors, the reality is 80% of households make philanthropic distributions. So what are they making distributions to? Half the money goes to religion and education. Half. Arts and culture, that's that pink slice up there. Can you see it? You in the back may need to come closer. It's small, so that's why we made it pink. It's very, very small. You are in an incredibly competitive philanthropic space. One of the things we talk to our donors about is if you can increase your educational aspect to your philanthropic enterprise, you move into a very different space by just increasing that. This morning when you listen to the member of the Board of Supervisors in his 5-minute, 27-minute introduction this morning, and he got the big applause line on education, public education supporting the arts. Let's be honest about it. LA Unified is not going to put a lot of money into arts. They have a lot of other things to worry about besides arts. But if you can fill that gap, because the community is starved for it, if you can articulate how you are filling that gap, all of a sudden the pool of philanthropic assets coming to you has increased dramatically. It's a huge opportunity. So when you talk about how you impact the community, keeping that education aspect as part of your value proposition is extremely important, because then all of a sudden you don't just have pink, you have pink and green, and that's a lot bigger. So we're strongly encouraging that. So of the people that are giving money, who are they? They're rich. What we did, there's the breakdown here. The green line is for the secular giving, and the purple line is religious giving. Rich people give enough to religion to make sure they're getting through the gates, and then they stop. And then the rest of it goes to secular. So we want to make sure that we are targeting the right people. and it's not an even distribution. It is an incredibly skewed distribution. So when we're out talking with our philanthropic clients, let's make sure that we're targeting the right donor base. This is where you're going to get the big hits coming into the enterprise, and they want to know that what they're doing is going to help their community, and you're going to be a partner in that, and we'll talk about that in a minute. But let's make sure that we really understand who these people are. These are the rich people that are making the big contributions. So what's happened recently? I don't need to tell a room like this. Contributions dropped off. In current dollars, they actually dropped off. When you do inflation, the bars are inflation adjusted and the red line is current dollars. There was only one other time where current dollars dropped off, and it was in the 80s because there was a tax change. So people front run their distributions, and so one year it kind of spiked up and the next year it came back to a trend line. But it was literally just a change because of a tax law. But they actually dropped off. But we're going to start to see, we think, back to an increase to a trend line because it's such an important aspect of people's overall balance sheets. So why is that? Why would that happen? Because people don't have a single investment goal. We tend to have those silly conversations with clients in our industry. We treat them like institutions. They may have institutional wealth, but they're not. They're people. So we say things like, so what's your investment goal? Well, they don't have one. They have like 12. They have food, clothing, shelter, estate planning, philanthropic, blah, 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 all these other things. And then my favorite is, what's their risk tolerance? What's your risk tolerance? And we use words like balanced appreciation. Well, I'm a balanced appreciation investor. My job is to come up with asset allocations for balanced appreciation investors, but nobody even knows what that means. That's my job. Give you an example of what happened in the psychology of this as you change. During the crisis, we were having lots and lots and lots of client meetings. So I met with a guy who was standing in the corner just in a catatonic state. And they said, Ron, go talk to him. I was like, oh, go. So I went and talked to him, and he said, I don't think you realize what's happened. I've lost $25 million. Like, I understand that intellectually, emotionally. We'll probably never have the opportunity to experience that, but intellectually I do. And I knew the answer to the questions beforehand, and I said, so how much money do you have left? I said, about 85 million. I'm like, so restate the problem again? So everything stopped in his world because of this $25 million. And I said, are you worried about food, clothing, and shelter? Like, I think we've got that covered. The kids are going to be educated. You're not going to lose the house. You're so focused on this $25 million that will come back eventually. In the meantime, you're ignoring this $85 million that can change the lives for generations to come in your community. Let's focus on that. And nobody had really kind of just slapped him across the face like that. That's why I'm a successful executive at Wells Fargo. So, as people are starting to repair, they're not just now focused on basic needs and lifestyle. We're going back up that pyramid to philanthropic, to the legacy, which is the estate planning. All those issues are starting to come back into the discussions that we're having with clients. And the reason for that is household net worth is improving. They feel rich again. He's now gone from 85 million, and he's now back into the 9 digits. He always feels better when there's a 1 in front of it. So he's there. But that psychology is really important. And I think what's interesting about this chart is, remember back to the dot-com bust, how catastrophically devastating that was? It's not even like a blip on the chart. Whereas what we just went through was unbelievable. We are starting to repair that, both the physical balance sheet and the emotional aspect of it. This is the time to get back in front of your donors and remind them of the full pyramid of investment objectives that satisfy them financially, physically, as well as emotionally. This is the time to get in front of them. But what's important is not just to talk about to the donors, but to who are the donors talking to. So today, USA Today, this great bastion of intellectual and economic analysis. That was condescending, I know. The USA Today snapshot. What would be the first thing you would do if you won $1 million tomorrow? Answer number 1. Give $100,000 to my local opera company. No, that's not what it says. But we're working on that. The first one, I was actually impressed. Hire a financial advisor. I was stunned. It's a third of the people answered hire a financial advisor. They're going to somebody for an opinion. The other two are paying off debt, paying off a mortgage and paying off credit card debt, deleveraging, which we're happy about. The last one is put it into a savings account. That is the stupidest answer. So Wells Fargo can pay, 10 basis points on it. Like, we can do better than that. But, if that same survey was done 5 years ago, I'd buy a house, I'd buy a car, I'd buy something. That's not what I'm getting educated and I'm deleveraging. Huge, very important. So when you're thinking about your donor base, it's not just the donor base, but who are they talking to? And what advice are they giving? You have to educate the advisors about the importance of philanthropic giving as part of the overall balance sheet. When we talk to our clients, these are the top 4 things we talk about. And the top 3 all have philanthropic aspects to them, and the bottom one is purely philanthropic. So tax minimization. People are very concerned about taxes. There's a big philanthropic aspect to that. Asset management. Obviously, being able to manage assets both for the family as well as the community. One of the things we talk about is the community is going to get your money one way or the other. You can either give it to the government and they can distribute it, or you can distribute it directly. You make the decision of what you think is the best way to distribute those assets to your community. Most people don't want to give it to the government. And then estate planning, huge part of philanthropic giving. So all of these topics are what they're talking with their advisors. If the advisors are not educated about the opportunities in philanthropic giving, we will miss an enormous opportunity. So I think it's important for your business standpoint to not just talk to the actual donors, but who the donors are talking to. That's why we have an enormous group at Wells that just does philanthropic asset management. It's very important. Talking about estate planning, so everybody talks about the baby boomers, right? They're retiring and all that kind of stuff, and that's all nice, and they need to now create income instead of capital growth and everything like that. When people go from working to retiring, that's also a typical time that they review and update their estate plan. The baby boomers aren't dying yet, but they'll start dying off in about 20 years. But if we wait 20 years to talk to them about their estate plan, it's too late. Now is the time, as they're making this major life transition from working to retiring, to get in front of them to talk about how their philanthropic giving can be part of their estate plan. If you wait until the death event, it's too late. That moment has already passed. So this is the time, as they're making this life change, an incredibly important aspect of communicating with the donor base. Speaking of the donor base, who are these people? Well, they're not just rich white men that are old anymore. It's changed dramatically. So when we talk about the opportunities and the carrots that we use to entice them, we have to really understand the demographics around it. Race, it's incredibly diversified. So we have to be able to address those needs of the different ethnic groups that now have financial resources that they're looking to improve their community with. Very important aspect of the communication. Gender. Just this week in California, 2 women had incredible political success. They didn't spend their husband's money. They spent their money, and it was a lot. So the money is not just being made by and owned by men anymore. It is a much better distribution that's only going to get better distributed over the next decades to come. So we have to be able to address both of those needs. And the sources of wealth, old money is nice, comfortable, a little tedious from my perspective. New money is really where a lot of activity is happening. We need to get in front of these people that have made money and now want to have influence with it. Once they buy all their little toys, then they realize the responsibilities of wealth. And part of the responsibilities of wealth is impacting the community around you. If you just build a big house, put a big wall around it, and fill it with toys, and don't care about the rest of the world outside of your house, then you have a beautiful house in a cesspool. But they realize you have to be able to influence the community around them, and so it's a huge motivation. So when you're talking to this donor base and the advisor base, let's pay attention to the shifting demographics, hugely important. So what motivates them to give more money? The 2 green bars there, those are about markets. Like, I feel better, the markets are doing better, I have more assets under management, I'm feeling more financially secure. Most of the others are your responsibilities. The bottom two there with the biggest ones, able to determine the impacts of gifts and lower administrative costs. You're the ones that have to be able to communicate that to the donors, so that they understand that the money they're giving actually is going to have meaningful impact, and it's not just going to go to pay for a big fancy office somewhere. But that's part of your value proposition to articulate why giving money to this entity will actually improve the life of the community that we live in. It's not just about putting on a performance. It's about improving the standard of living of the community that we live in. Very important aspect. I love the fact that there's only 2 on there that are really market-driven. The rest of them are your responsibility. And once you have that conversation, it's amazing how they open up. We spend a lot of time with our philanthropic management group articulating those value propositions for our philanthropic clients. Extremely important. One of the big aspects today is the younger donors. So money's being made, and people are realizing that they can have philanthropic partnerships out there, and that's an important aspect. They don't want to just write a check and get a name in a program. They want to be an active part of this enterprise. They want to make sure that there's impact, that they are having a partnership. It's a business relationship with their philanthropic enterprises. You can articulate how that partnership can be built, how they can be actively involved. What a wonderful way to not only use their financial resources, but also their sweat resources to your advantage. Bringing them really into the fold, they want to be actively involved. It's not about, I just want to write a check, get my name in a program, and go to a fancy ball. I want to really work, understand the impact that this is going to make on the society around me. It's an extremely important part, and I think an enormous demographic change in the donors. So as they're starting to feel more financially secure in their families, they now want to reach out and say, I need to make my community more financially secure. I know the state budget is a mess. I know the municipal budget is a mess. I know the United States government budget is a mess. I'm going to participate in improving the community around me. And this is an important way that you can go about that. So in conclusion, if I can get that to work, the reality is we are going through an economic recovery. It will not look like it looked in 2006, and I think that's an important thing that we have to remind our donors and investors. Recovery doesn't look like 2006. As Mark was saying, that's just kind of going back to the old ways that wasn't sustainable. It will look different. There is an emerging middle class around the world. Emerging economies will, the projection that we have is in 2014, so not that far away, emerging economies will account for more than half of the global GDP. Today they account for about a little less than 40%. So when do we stop calling them emerging? When they're more than half of the world GDP. Now, the population is much greater than half, so per capita GDP is still much, much smaller, but nonetheless an enormous force. So a demographic change. We're also seeing a demographic change in the distribution of wealth around the world. It's not just old money parked in places that is very secure, but money's being moved around, and people are taking more social responsibility for the wealth that they have. Wealth is no longer just about buying goods. Nothing on that list was about buying something. It was all about taking financial responsibility. An important part of that financial responsibility is supporting the philanthropic enterprises in your community. So we think this is the time to get in front of people whose balance sheets are being repaired, baby boomers who are retiring, and people that are feeling more financially secure and responsible for the community that they live in. And we think that if you can articulate your value proposition effectively of how you're going to influence that improvement in the community, you will experience a dramatic increase in donor contributions and enthusiasm for your enterprises. So with that, I'll have Tim come up. Thank you for your time and invitation, and I'll be around.
It's hard to follow, Ron, isn't it? I just wanted to wrap up for a few minutes, and then we'll conclude. One of the themes that I love Ron's story about the 85 million and losing the 25 million, and what it really shows is what the minds of many of our donors are thinking is that even though they do have assets, we need to have the right discussion with them and refocus that discussion, which Ron did beautifully. You may not be able to do that quite as bluntly as Ron did, but but he did that beautifully. And really what I wanted to just spend a few minutes on was connecting your donors and connecting that passion for opera with them. And I just have a brief story on that, of something that I did for the Metropolitan Opera several years ago. And what I did was, they came to me and asked if I could do a presentation for everyone who'd left the Met in their will or was a planned giving client, et cetera. And I said, you have these lovers of opera, and you need to combine that with these dry tax and estate things, and how do you do that? So I said, let's take, they were just at that time doing a production of The Magic Flute, and it was in rehearsal, and I said, could you give me 5 pictures of the current characters of that? And I created a presentation that essentially looked at what happened after the opera ends. And I created a story, here's Palmina and Tamino, and they had a kid, and they did a will, and they left the Met. And they left the Met, they did a small charitable gift annuity with the Met. And here's Zoroaster, the single male, and he had a large estate, and this is how it impacted. He did a charitable remainder trust and gave the Met money out of his private foundation, et cetera. And it just showed, really connected to that audience what was really at their heart. And I also showed the picture at the time of Zoroaster, and then I showed his, and I did his aria and the duet for Palmina and Tamino, and I ended it by changing the words to disbildness and change the words to be how do you give money to the Met in your will, etc. So it was my Met debut. But it's just a living example of creative things that you can do to connect that passion for the arts that your donors have, to change the discussion around, like Ron really talked about, because it's hard talking to people about giving money. As board members, some of you are probably board members, it's hard to talk to your peers about that. As fundraisers for organizations, it's hard to go out and do that. So if you can really connect with the values and passion that your clients have, that your donors have, I think that's really something that's worked well. And I've seen that work well over the years. A few quick themes. Donors want to know that the assets that they give to you are being managed well. And when you look at a lot of your donors, they're wealthy business people, they're very sophisticated, and they want to know that. So it is important to look at some of these themes that we're talking about and have those investment discussions, bring in other professionals to have that with you, because they do want to know how you're managing those assets that you've given to them. So whether that's a planned gift or it's endowment or it's just for the operations, they want to know the statistics around that too. International philanthropy, international donors is something we're seeing a lot more of with some of the trends that you just heard of where wealth is going to be created in the future. That's going to become an increasing theme, that you know how to work with a donor from somewhere overseas for your organization, or vice versa if you're an international organization that you work with U.S. donors for making gifts, for instance, tax deductible overseas. So those are some themes that are really important, and you want to make sure you get some advice around. Planned gifts, I think your question on the gentleman in the front row who's reading his BlackBerry right now, your question on the estate tax, planned giving, I think, so gifts of charitable gift annuities, charitable remainder trusts, charitable lead trusts, et cetera, you're going to see that, I think, as an increasing, coming back a little bit because of the estate tax, the jokes about dying today is the best thing you can do from an estate tax plan, but that's going to come back. You're going to have an estate tax. We'll probably have higher taxes in general, and people are feeling like they get a little wealthier than they used to be. 85 million to now 100 million, and so I think you'll continue to see planned giving. That is a theme that for your organizations, the organizations that have been very successful in planned giving have
year in and year out, committed, talking to their donors about that, because 80% of any planned giving program is usually simple bequests. It's not the fancy CRTs and CLTs, it's simple bequests, and including your organization in the will. And then endowment building. Organizations that are making it through right now have a little bit of a kitty put aside, have been able to make it through better. So that's an important theme to start to build your endowment if you haven't, because there are going to be some other rainy days in the future. And I think donors right now understand that endowment gift better too, because they want to see you succeed on in the future. So those are some themes I just wanted to mention, and it's been a pleasure being here with you. We do have an opportunity for you. We have a booth out in front. This is my only sales pitch. We have a booth out in front. Janice Burrell, one of our experts, who actually at one point was the planned giving director at Loyola, she will be there to talk with any of you about planned giving, as well as anything else you want to talk about, donor questions. We also have some other Wells Fargo representatives floating around that can talk to you about your situations, your donor situations, and we thank you very much.